The wealthiest people in the world aren't rich because they earn more, but because they keep more of what they make. Whilst helping over 900 businesses restructure to protect their money and assets, I have discovered 5 completely legal tax loopholes that work wherever you live. These same principles can save you thousands in unnecessary tax without breaking a single law. So in this video, I'll show you exactly how these work so that you can understand how to protect what you've built legally and transparently. Governments don't need to be right to make your life miserable. If your setup looks artificial, even if it's legal, they'll still come after you. So the golden rule is simple. Do not wake sleeping dogs. Never say, I'm avoiding tax. Say, I am structuring my wealth. Let's start with the first legal tax principle. And this one alone explains why some people pay less tax even when their income looks exactly like yours. You can work your whole life, 50% in tax, and still get taxed again if you move your money abroad. And that's because most people never ask where their company is truly managed. In many cases, tax authorities look at where management and control happen, not just where the company is registered. If your decisions, meetings, and directors are genuinely based in another jurisdiction, and that is documented, then that is where the tax residency may apply. A client of ours was a Canadian entrepreneur who ran his business operations from Florida, but he was still paying the full Ontario tax. Once his management and residencies were aligned and documented, his global effective tax rate dropped dramatically, fully within the rules. But once you have aligned where you manage your company, the next question is how do you hold your profits? Because the structure that holds your wealth determines whether you're taxed once or twice. Ever notice how billion-dollar companies sell subsidiaries and pay almost nothing in tax? Meanwhile, you sell yours and half of that disappears overnight. In the right jurisdiction, with proper substance, dividends and certain capital gains at the holding company level can be largely exempt, while still fully declared under your own tax rules. This is called the participation exemption, and it's one of the most misunderstood benefits in international law. A client of ours is a Canadian founder who exited for tens of millions of dollars. He rebuilt under a Swiss holding structure. Now, dividends from his subsidiaries flow into that parent entity, legally, transparently, and fully declared. His profits compound inside a compliant framework designed for reinvestment. But even the smartest structure can be collapsed if it looks fake on paper. And that's why the next principle, commercial substance, separates legal efficiency from instant red flags. Every year, many entrepreneurs lose everything because their structure looks artificial, with no staff, no records, no decision logs, and the tax office call that exactly what it is, a sham. And they proceed to charge you with tax evasion, which leads to huge fines and even jail time. A compliant structure must have commercial substance, which means activity, contracts, directors, and decision making that matches reality. Even a minimal presence is better than none. One local operator, an office address, documented minutes, proof that the business is real. A real estate investor came to us wanting to go offshore. Instead of paper shells, we helped him establish a genuine US operation with invoices, service agreements, and local oversight. He saved significantly compared to his old setup, all fully vetted by local advisors. And once your structure has real substance, you unlock something even more powerful, the ability to make your companies work together across borders in full compliance. Most entrepreneurs treat each company like an island. They pay full tax in each one, and they never realize that those companies can legally complement each other. Where there is real US activity, your US company can charge for that work at market rates. This is otherwise known as arm's length pricing, and that could be taxed at 21%, whilst your Canadian company is taxed on what it actually does at Canada's tax rates. This all must be based on arm's length pricing with real substance and documentation. One client of ours was in the trades, rebuilt his structure in this way. His Canadian business stayed active as a supplier, and his US company became the hub for real operations. He now pays significantly less taxes and lives with complete peace of mind because he's completely within the law. Once the international ecosystem is running correctly, there is one final step, the layer that the ultra wealthy never skip, protecting the system with governance, privacy, and succession. You can build wealth for 40 years and lose half of it overnight to lawsuits, a divorce, or poor planning. It's painful and unfortunately very common in Canada, and it usually happens because assets are held personally instead of through governed structure. The wealthiest don't hold their assets in their own name. They use foundations and trusts with proper governance, so their assets are protected, succession is clear, and everything is fully legal and visible to the right authorities. One client of ours is in his 60s. He lost millions in a divorce before restructuring. Now the foundation owns the assets, and he participates through clearly defined legal rights, giving him protection and continuity within the law. So when people say the rich play a different game, they're right. It's not a secret game, it is just the compliant one that nobody ever taught you. None of the information in this video is advice of any kind. It is for educational purposes only. None of these 5 legal tax principles are shady or hidden. They are strategic and compliant, because it's not about paying no tax, it's about paying the right tax in the right place for the right reasons. If you're serious about protecting your wealth and structuring it properly, start with clarity. If you want to protect wealth and optimize taxes, you don't need loopholes. You need to build compliant structures and strategies, which is exactly what my company does for high net worth entrepreneurs. If that's you and you'd like to understand what is legally possible for your case, then you can book a call with my team for a private review. Just click the link in the video description. Even with the right structure, if your profits sit inside a high tax system, you're still compounding taxes, not wealth. If you'd like to go deeper and learn more about how structure actually reduces taxes, regardless of where you live, then watch this video next, where I show you how entrepreneurs legally move profits into lower tax environments, because the step after that is sovereignty.